Yesterday, I discussed one of the methods for using the context dashboard to calibrate expectations for the day. In this case, there was a large gap up, and we looked at some of the ways that you can better account for the distribution of day types and what each of them may look like. Today, you can do the same thing, and I thought it might be useful to look at it in kind of contrasting environments. So here we have a 15% gap down, 6-point gap, and this wedge structure on the open. So for traders who see these two relatively strongish bear close, bear follow through, and thinking this is first an outside bar, so problematic, but thinking that this might be the start of a bear leg in a bear trend, and perhaps sell the close, or are thinking bearish at this point. Going through this exercise around the open might actually help you better prepare for the actual distribution of likely day types. So let's take a look at the context dashboard. All right, and we want to look at a range. So we want to look at a bear gap. So we want it to be between this range, so minus 20 to minus 10, a bear gap, so 15 falls right in the middle of that range. And we can see what percentage of days have that size of a gap. Then we can go down, and we want to account for what occurred yesterday, right? So yesterday, the session closed above the previous day's range. So the previous day filter, end of day closed above the previous day's range. So we'll add this. This is going to make our data set substantially smaller, so by a little more than half. And then we want to look at a few key items. So we'll actually, let's make sure that this understands that we're in a bull regime on the daily time frame. So then we'll filter one more time. This gets us down to a relatively small data set. So 35 days does have statistical significance, but it also makes it more difficult to have relatively narrow probability distributions. Like we can see here, when we look at the probability for the gap to close, it's 88%, but it's a band of almost 20%, right? So 78 to 99%, right? That's not going to be as useful. The probability is highest on bars 1 to 9, but again, now this is closer to a 30% variability in this band. And what's interesting though is that we see this is the highest, and then the next period, and then the last, right? There were none of those 35 days closed the gap between bars 19 and 72. So this tells us something, or should tell us something, about the type of day and the day structures that might develop. Just intuitively seeing that this is the probability distribution for this data set. So then what we can do is just go turn this on and print some charts. And this is something that you can do around the open. Once the first bar opens and we know what the size of the opening gap is, we obviously know what the previous day close was. And then we can start just thinking about what the day structure might look like. And here, gap closed on bar 2. Where did the gap close? Gap closed on bar 1. But one of the things that we can immediately see is that so far, none of the days were bear trends. They were all either trading ranges, trending trading ranges, or bear channels. We had one bear channel. Here's a parabolic wedge test of previous day's low, and then trending trading range, trending trading range, trending trading range, trending trading range. Right? And these are obviously all, there's variations in the type of trending trading range. Here, again, trending trading range day, but with much larger swings in each direction. Trending trading range day. You might consider this, I mean, it's really a bull channel, but with, from bar 30 low to the end of day. This basically defined the end of day trading range. Here, trending trading range, but it's expanding triangle trending trading range. So new high, new low, new high, new low, new high. Another expanding triangle trending trading range. Okay, and then we have all of our configuration settings. So the point is that on the open, now let's go back to our chart. When we get this bar closing here, having gone through 35 charts quickly, that give us basically, some of the highest value inputs for understanding what the day type will likely develop as. It helps us better understand what we should be doing here, and if it leaves us confused or uncertain, it should also help us to confidently not take a trade and just avoid anything in this this wedge structure until we have some kind of attempt to break out. And then once we get this failed bear breakout and reversal, can start looking at obviously the trading for the close of the opening gap, which we know has a higher probability of closing. But interestingly, if we return to the distribution analysis here, let's turn this off. We know that after bar 18, we have none of the days in our data set close the gap until the end of day. So that would be something to consider as well. So, as you're looking at the developing price action today, bar 18, that was it. So now do we think that this is going to go up and close here and be the one day in those 35 days that will close the gap outside of those first 18 or last 9 bars? Or do we think this is going to create a trading range and attempt to close the gap later in the session? All things to watch, and things to think about as you are calibrating your expectations for the type of day that will develop. This is just one of the ways to use the context dashboard to prepare for the trading day. Obviously, there's many other and more sophisticated ways to use it when conducting research, but as far as a live trading tool, this is one of the more significant values that it can provide. So this is something that our SA2 students next year will be using both as a research tool and for their live trading preparation. And we'll hopefully be getting some feedback from others who are using it outside of Systems Academy, who get some benefit out of it and some perspective on the way that they should be thinking about the day. Let me know if you have any questions and drop them